market-related plays, be it NAM India, be it Anand Rathi, I think some of the brokerage stocks, all of them seem to be doing okay as well. But thanks for tuning into Talking Point. The case for the chat for the show today obviously centered around geopolitics and whether the geopolitical concerns will weigh in on risk assets in a meaningful way or not. Will oil spike enough to hurt macros within India? And we will at some point of time in the show talk about IT in great detail with our guest. And never mind the corrective moves that we've seen thus far, because of the lack of positive commentary, does IT remain an avoid? Pose all of these questions to Nirav Sheth, CEO Institutional Equities at Emkay Financial Services. Nirav, great having you as always. Thanks for taking the time out. I hope all is well.
Thank you for having me, Niraj.
Now, the pleasure is ours, Nirav. Nirav, what do you do in a scenario like this, which is as fluid as it is right now on the geopolitical front?
Well, Niraj, over the last several years, I don't think that we've ever invested in a market where, you move from one concern to another concern, right? You always need to be cognizant of what can impair the structural growth story or inflation outlook or your interest rate outlook. And many of the cases is not very easy, right? The way to look at it is, there are two things that has happened, right, over the last, maybe a fortnight or so. One thing that it increasingly seems that the pivot that Fed took was probably premature, in a sense that your inflation is moderating, but is not moderating fast enough, and this is largely around shelters and service part of the economy. Second thing is obviously the escalation that we are seeing on the Middle East front. To me, this is probably, I'm talking about the geopolitics, right? It is not a happy situation. A lot of human lives are involved, but this is of a degree considerably lower in intensity than what we had seen with Russia, Ukraine, right? And we are able to live through it. Russia is a far more dominant player in the oil market. Europe was completely dependent on energy for Russia, right? So the dislocation in the global energy market was of a degree significantly higher. We are not very close to that as far as the Israel-Iran thing is concerned. And it also has an offsetting implication, right? So if you every time you got an escalation in geopolitics, you will see that people rush into bonds, and therefore you've seen about a 10 bips rollback in the bond yields. I think that this will keep a lid on the risk assets for some period of time. I don't see a significant escalation. I don't see a significant risk of trade right now from what it looks like.
Okay. Nirav, are you a buyer, therefore?
I am super bullish on Indian economy, right? And by that definition, Niraj, it is always, these are the times that you want to go and buy. And when I'm talking, these are the times, maybe the stocks could be down another 5-7%. To me, that is the base case scenario. Given the fact that if you look at the economic narrative in India, if you look at the political narrative in India, and if you look at the macro scenario in India, these are very, very strong dynamics playing out, right? And therefore, you need to be buying equities with an horizon which extends into 2, 3, 4 years. I believe that you will have probably a lifetime opportunity pre-elections buying into Indian equities.
Mm-hmm. Yeah, Nirav, just wondering. So, I agree that the longer-term view is very positive. You are not waiting for a tactical lower opportunity because it might be difficult to time the bottom. Is that it?
No, I don't believe that you are going to see a significant drawdown.
Okay.
Right? Because you need to cut the earnings for markets to go down. Right? So there are two levers to the market. A is your evolution of the earnings. Second thing is your discount rate. You slightly, sort of hazy around, how my risk-free rate is going to behave. But but if you look at the earnings evolution and if you are looking at the ROE evolution, you are talking about a $4.5 trillion economy, which is growing at about 6.5%. Earnings are going to compound at 14 or 15%. I don't know whether you'll see a meaningful correction.
What about the other overarching factor, which is the rates and the yields? Much to the chagrin of bulls, we are not likely to see rate cuts in a hurry, at least as the sound bites go right now. And therefore, higher for longer rates, the multiples question, the discounting factor, all of that comes into question, Nirav. Would the street be disappointed with no rate cuts or not quite?
Well, it depends upon why the rate cuts are being pushed out, right? So if you look at since December last year, the first 4 months, you essentially had an unusually resilient US economy. Essentially, the payroll numbers were holding up very well, the wage growth was moderating, but the US economy was doing better than expectations. And if your economy is doing better than expectations, which is why you're pushing out the rate cuts, that is risk asset positive, as far as I am concerned. The last print that you saw was on inflation, right? And essentially around shelter, which is still seems to be sticky at about 5%. If the inflation print doesn't moderate in line with expectations, then you need to be slightly worried about the impact on the risk asset. So the question is that why are the bond yields holding up higher? Is it because of higher economic resilience, which means that I'm looking at long-term higher terminal growth rates, or is it because of stagflation scenario? If it's latter, the risk asset will sell off. I don't see inflation so much to be a concern, right? You never have a linear disinflation anywhere in the world. It is always a bumpy ride. I would still believe that this is more of a noise. You should be seeing rate cuts sometime in maybe September onwards. Do keep in mind, if you look at the expectations for headline inflation in US and core inflation in US for 25, they are at 2.3% and 2.1%. So even if I reduce the rates by 50 basis points, you'll come to somewhere around 5% or 4.75%, which is still fairly restrictive, right? We are not talking about whether it will go back to 2% or not, but I think the process will start.
Okay. Nirav, now one more question, and you know, we'll actually just cover the macros here because we'll get into specifics in the next segment. If I heard you say that you do not believe that there will be too much of a downside, but that is ceteris paribus. If indeed the Middle Eastern issues around Israel and Iran escalate, then tactically, I presume, you would wait for lower levels. Would that be a fair assessment or not quite?
Yeah, of course. So in one of the scenarios that I try and build into, so right now it seems to be certainly an escalation between Israel and Iran. Now, whether that gets other Middle Eastern countries into it, and therefore it becomes a wider Middle East conflict, then obviously there'll be a significant more impact on oil prices and your dollar inflows and stuff like that, and therefore you could have potential another 5 or 7% rate cut. It is a scenario that you have to build in. To me, there are reasonable odds, but it is not my best case scenario. The reason I'm willing to take this line of thinking is because Israel seems to be isolated in its attack on Iran, right? This is not, the allies have not been necessarily supporting Israel in terms of escalating this thing with Iran. But we'll have to wait and see. It is a possibility with lower odds, which can create a 5-7% cut in the markets.
So viewers, remember, I mean, I think it was important to lay it out because Nirav is per se bullish, with the base case being that this conflict will not escalate. If that were to happen, then some of his previous bullishness tactically gets revised, maybe 5 to 7% lower. But at those levels, presuming that things don't worsen too much, that is where his optimism around India earnings and thereby growth in equities in India come to the fore. Now, what within this whole sphere? We'll talk about that with Nirav on the other side of this very, very quick break. Stay tuned.
I'm Tanuj Bhojwani, and I run People Plus AI. We're an organization that helps startups build AI. Is AI useful in India? Most definitely, yes. We have a huge, approximately 60 crore people using the net passively, meaning they're watching YouTube, Instagram, etc. But perhaps only 20 or 30 crores who are actively contributing or transacting on e-commerce websites. One big hurdle is because this involves typing, needs you to be literate, comfortable with using the smartphone, etc. One huge area AI will change in India is the use of voice, video, and other multimodal technologies. These new LLMs can understand human voices, accents, and languages like nothing ever before. Think Alexa times 1,000 because you can talk to it in your local language in an accent. Many companies, including Sarma and Krutrim in India, are training these models for Indic languages and the way we speak to each other, in mixed coding, where we use Hindi, English, Marathi seamlessly. This is why we believe exciting times are ahead, as AI can unlock access to computing, apps, and that
जेव्हा जग धोक्यामध्ये असतं, येतो जॅव्हलिन मॅन. हे फेकलं, हे मारलं. जॅव्हलिन मॅन, जॅव्हलिन मॅन.
ह्याला एव्हर रेडी अल्टिमाची अधिक काळ टिकणारी पॉवर पाहिजे. टॉयजनी मुलांची कल्पनाशक्ती काम करत राहते, म्हणूनच यांची बॅटरी चालत राहायला हवी. नवीन एव्हर रेडी अल्टिमा बॅटरी आहे 400% लॉंगर लास्टिंग.
So the usual has happened, back with talking point of course, and the usual has happened in trade on Friday, that oil spike has led to OMCs coming off and some of those. But the point with our guest is that some of these dips should be used to buy into. Now, Nirav, I'd like to start off with what is it that you are most constructive on? The biggest electoral exercise in the world is underway starting Friday, the 19th of April. We have this geopolitics, all of that, and the earnings season in full blow. Non-IT, because we'll talk about IT separately, Nirav, non-IT, what is it that forms a part of your ready reckoner list, if you will?
So, and I'm keeping the valuations aside right now because I'm talking about the macro. So, I am very constructive on how the capex recovery is going to come back, right? And this entire chain from power to renewables to electric vehicles and green hydrogen and generally investment in cement, steel, stuff like that. So there's a big tail over there. So very constructive on how the capex recovery will happen. We are also constructive on the discretionary part, right? So anything that is leveraged to Indian economy at large, and that includes financials. Within that, obviously, constructive on the PSUs as well, and even the NBFC space. And thirdly, I am particularly excited about what I would call the shunt sectors for long and still trading at very, very interesting valuations, which is something like, an ONGC or Coal India. The free cash flow yields are even today at about 9 or 10%. I also would like to believe that I would expect the Prime Minister to use his political capital in the third term to dramatically change and raise resources through the public sector units. As far as the ideology is concerned, they are very, very prudent in terms of their fiscal prudence. You still have to raise resources to try and do some serious pumping up of infrastructure. Countries like India are asset heavy and income poor, right? So you can potentially raise billions of dollars through the public sector assets that have been created. And if you're not going to do it now, then when are you going to do it? I'm willing to take that call that you will see, they have laid the template for it. They are run very well. They are governed very well. Valuations have started to catch up. Now it's time to monetize them, raise resources, recycle those into more and bigger infra projects. And therefore, you're going to see unlocking as PSUs as a space.
And remember, viewers, Nirav was amongst the first people to give a call way back, I think in 2020. I say this almost every single time, on PSU banks being the outperformers, and boy, did that call turn out to be true. We'll talk about these, but I want to invoke IT before we talk about it, because IT is the newsmaker. And let me first get in my colleague Rucha, who tracks this space very closely, to come in and talk about the key highlights for Infi. And viewers, don't get confused if they sound eerily similar in some fashion to some stuff that even TCS had to say. But Rucha, Infosys, correcting ahead of the numbers, correcting post the numbers, what were the three key highlights for you?
Infosys has given a very muted guidance, but the management has mentioned that the first half of next year will be strong on the back of ramp-up of the BSNL deals in the BFSI sector, which means that the second half will largely be soft. Second, the deal wins are highest ever, but does that really matter? Because that was the case with TCS as well, and that is not getting converted into the top line. And lastly, clients are opting for more of cost optimization deals, and these kind of deals generally come with tighter budgets, which can impact the IT company's margins, and this implies that there is still pressure on discretionary spends, which even the TCS management had noted on last Friday.
Rucha, net, Accenture, TCS, Infosys, as big as it can get, we're not seeing clarity on discretionary spends coming in thus far, right?
Yes, that's correct.
Okay, Rucha, thanks for giving us a very quick update on this. Now, Nirav, come in on information technology here. It's a sector that's long withstood every test. Is the timing, though, wrong for somebody to take a contrarian call?
Well, my sense is, it's a bit of a difficult call. And I believe that the things that are impacting the software sector are not only cyclical but also structural. Now just look at how the captives are building up their base in India, right? So if you look at broad evidences in terms of the real estate space that are being signed up by captives, I would like to believe that captives are outperforming the traditional outsourcing Indian IT companies, right? So that is a part of the growth that is being redirected towards captives away from our homegrown Indian companies. If you look at the mid-cap IT companies, they are outperforming the large-cap IT companies. So my sense is that you've got a growth distribution that seems to be happening because there is not too much of differentiation left. So part of the smaller deals are being taken away at the bottom by your mid-cap IT companies, which are probably growing at twice the rate of my large-cap IT companies. And obviously, the captives themselves are insourcing a lot of the work which ideally would have gone to the IT companies. So you need to adjust for that. So if you ask me, I don't have a great view in terms of what my long-term growth rate in free cash flows are going to be, right? So today we're going at 2 or 3%. The median expectations are the CC growth in dollar terms will be roughly about 6 or 7%. Whether it's going to be 5%, 6%, or 4%, at least to me, it's a bit hazy, number one. To me, a bigger problem also is the fact that when I look at the next 3 or 5 years, I believe that India rupee will be a significantly stronger outperformer. We are already seeing that right now, right? We are one of the best performing currencies year to date after US dollar, right? And this is despite the fact that we are still a current account deficit country, right? So when I look, just look at the latest print, right? Where trade deficit is roughly about $15.5 billion. And I think your service exports are close to about $15.5 billion. So there is a dramatic change in my current account situation, and try and forecast that over the next couple of years. So you're potentially looking at a significantly lower depreciation of the rupee. It could even be flattish as you move forward. And that has implications in terms of how you look at the margin outlook for a lot of these IT companies, because there is implicit building of rupee depreciation go forward. All told, I am negative on IT companies given the valuation they're trading at this point of time.
And therefore, viewers, at times it may not even matter. I mean, you don't necessarily have to have IT in your portfolio because you don't have benchmarks per se. I mean, unless you're a fund, of course, you don't have benchmarks to meet per se. And even if you do, I mean, unless you're a mutual fund, a PMS, a fund is okay to not necessarily stick to those benchmarks and outperform. Nirav, at the start of this segment, you mentioned that you believe that a couple of things could happen. One, some of the PSUs, independent of how hard decisions are taken or no, just the numbers, the dividend yield at which they are present in, etc. ONGC, for example, might do well. And there have been significant upgrades that have come in recent past as well. Is oil upstream and ONGC, Oil India, etc., all of them great plays, or do you like ONGC in particular? I'm just trying to think out loud.
No, I think I like the entire space. One way, like I said, is I'll never argue that the markets are cheap, right? But you cannot buy a great story cheaply. It is not possible. And if the big corrections come, they'll come because there is a dislocation in earnings. And by definition, that means that the outlook is not too great, and therefore maybe the investment may not be too great as well. To me, I always believe that one way to look at this is that you are bullish on India, you are putting 95-98% of your portfolio, consider portfolio. I always look at oil companies as an insurance play, right? The only thing that can derail India's story in the near term is an escalation in oil prices, which impacts my balance of payment problems eventually, and rupee depreciation and stuff like that, and inflation. This is an insurance to that portfolio that you are creating. And instead of paying a premium, you're getting a premium because they are yielding you about 8 or 9% in terms of free cash flow yield. In many cases, the dividend yield is about 5 or 6%. And therefore, it's a no-brainer. Secondly, I think markets routinely overestimate, what you would call this a transition away from dirty assets into renewable assets. And we overlook things like Coal India and stuff like that. It is not possible to wean away of coal for a long, long time in the future, right? So usually that gives you very, very solid entry points in terms of valuation.
That's an interesting twist. Buy oil upstream as an insurance premium. Didn't quite hear that, but I think that logic is very sound. I just have one last question, Nirav. And that's on arguably the story of the month, the revival of Vodafone Idea, right? Now, is Vodafone by itself a good play to your mind, considering that there is a lot of smart money that is coming in, they are raising capital, they'll raise debt, they'll spend on 4G, they will stop losing customers the way they have, presumably, in the future as they have in the past. And does the revival of Vodafone Idea hamper Bharti Airtel and others, or do you think the space now looks pretty exciting? How would you characterize telecom?
Well, to me, a large part of the trade or investment in telecom sector is behind us, in a sense that logically you should expect a significant reset in tariffs as we go forward. And therefore, all of us know the investment case. It is a perfect duopoly, and there are two large players, and they are past their heavy capex phase, and therefore the outlook looks to be good. But you also want to keep in mind that this is finally an ex-growth market. So once you got a tariff which is getting reset and your earnings reset at a higher level, there is no growth. It is not a compounding machine by nature, right? And therefore, I'll be very circumspect about giving high valuations to these kind of assets. I have not looked at Vodafone in great detail, but I have always believed that when the sector turns around, you also make money with the laggards. Vodafone, to the best of my knowledge, will not be a price, setter. It will be a price taker. It's a high tide, and you'll benefit from that as well. And it's great that they've been able to raise money, and therefore you can restructure your balance sheet, which has been a great pain point. If I could think out loud, maybe at some point of time, after a couple of years, there could be even a significant takeout value sitting over there.
Great. Nirav, always great insights. This time, no different. Thanks for taking the time out and speaking to us.
Thank you so much for having me. Pleasure talking to you, Niraj.
And viewers, thanks for tuning in. This is